This is Frank Islam, Chairman and CEO of FY Investment Group and your host of Washington Current Review, where we interview leading voices from business and politics and explore the topics of current interest that impact you, the viewer. Today, our guest is Daniel Rauchle, head of the Alternative Strategies Group for Wells Fargo. He will be talking about the investment strategies in the alternative asset class. Welcome to our show, Dan. Thank you very much.
It's nice to be here.
I'm glad that you're here today. Talk about alternative investment, Dan. Can you start telling us what the alternative investments are?
Sure. Well, the word alternative means that they're alternative to traditional investments. By traditional investments, we mean stocks and bonds, or mutual funds or exchange-traded funds that are composed primarily of stocks and bonds. So these investments are an alternative to those. At Wells Fargo, we actually prefer to call them complementary because we don't see alternative investments as an alternative to, we see them as a complement to an existing portfolio. They should be included as part of an overall portfolio. And these alternative investments or complementary strategies generally are considered hedge funds, private equity, venture capital, and real estate that's held for investment purposes. And they're, again, often used to complement a traditional portfolio.
So what are the benefits of investing in alternative investment?
Well, the primary benefit
besides getting a better return on your investment?
Not necessarily.
Okay, and it's pretty risky in some of.
You'll see that as the last point that I touch upon.
Good.
The most important thing is that they have low to moderate correlation to traditional portfolios. So a traditional portfolio composed of stocks, say you own an IBM stock, the overall marketplace goes up 10%. On average, your IBM stock is going to go up 10%, maybe a little bit more, maybe a little bit less. But that stock has a high correlation or connection to overall market movements. Alternative strategies generally have a low connection or a low correlation to overall market movements. So by adding them to your portfolio, when the market goes up, they may not go up as much, but when the market goes down, they may not go down as much, and they smooth your overall returns. So that low to moderate correlation is the primary benefit, and we put that into the overall category of diversification. If you add those to your portfolio, you have greater diversification of your return streams.
So this is all part of the diversified portfolio. That's what you're talking about. And get a better return on your investment.
Now, certainly some alternative investments, not all, also have the potential for higher overall returns over longer periods of time. They may be more risky to get that return, but it gives you the option to go there. But the vast majority of alternatives, and the reason we employ the use of alternatives, is really for the diversification benefits.
So are these investments that you're talking about, the alternative strategy, available to only quote-unquote rich or wealthy people?
Well, certainly that's what we hear about, and here's a little bit more of the background there. Alternative investments are generally structured as limited partnerships or limited liability corporations, where their primary business is the business of investing their limited partners' interests. And in doing so, they're limited in what they can do if they turn themselves into a registered vehicle like a mutual fund and have overall registration with the Securities Exchange Commission, who then sets rules on governing how they can invest. So what these pools have to do is they have to exempt themselves from registration. And in doing so, they have greater latitude on how they invest, what they invest in, what investment techniques they use. But the trade-off is the only people that they can receive money from as investors are people that are considered sophisticated. Sophisticated enough to watch out for their own interests without the Securities Exchange Commission setting rules for them. And the proxy that's used for, if you're a sophisticated investor, is whether you have either $1 million or $5 million of net worth, which allows you to qualify to invest in most alternative investments. So yes, there is that limitation out there, which is unfortunate.
So 1 million to 5 million?
Correct.
Well, which isn't bad. What about the institutional investors? I mean, you got a lot of the institutional investors, especially the pension funds. Do they invest in hedge funds and other alternative investment?
Yes, they do. Although the hedge fund industry in particular started really with high net worth individuals. Over half a decade ago, or 50 years ago, a group of high net worth individuals would pool their money together, and they'd find one individual that they could hire to manage their pool of assets. And that, in essence, was the first hedge fund, and there were no restrictions over how that person invested their assets. And that kind of approach proliferated over time. And then in the late 80s, early 90s, certain institutions started to see these pools of managers out there that would use alternative investment strategies to invest assets and felt that it was a good idea. So starting in the early 90s, institutions such as foundations, endowments, and pension plans started to deploy capital into hedge funds and grew the industry and really took the hedge fund industry from kind of a cottage industry more into a well-recognized investment strategy, the hedge fund universe. So yeah, most universities with endowments will invest somewhere between 10 and sometimes as much as 40%
in the hedge funds,
in alternative investments, including primarily hedge funds. Yeah.
There's a lot of talks in the Congress about hedge funds and not regulated very well. There's a lack of regulation by Security Exchange Commissions, and as you probably heard that many hedge funds did not do very well. They went out of business. So you mentioned the hedge funds probably the most widely known type of alternative investments. How do you feel comfortable saying to the audience that this is a good investment if you got a good people to manage? And what exactly my second question to the following question is, what exactly these hedge funds managers do? Mm-hmm.
Well, to the first part, which is really talking about...
I've given you big several questions here on one day, and I apologize for that.
Oh, that's all right. Addressing the first one, which is the regulatory issue.
Yes.
So hedge funds are generally loosely or lightly regulated. They have very little regulation out there. And when we talk about what happens in the industry, we have to separate structural risks from investment risks. The fact of the matter is, in 2008, when we have a very challenging equity market, our estimate is somewhere between 90 and 95% of hedge funds lost less money than the marketplace. So from an investment standpoint, many of them did their job of preserving capital in those kinds of conditions. What we read about, though, are the hedge funds that somehow get into some kind of trouble, which is generally structural issues. And that goes to, are these hedge funds set up with the appropriate controls around their legal structure, their vehicles, their operations, their administration. And that's where the regulation really should focus. We happen to promote at Wells Fargo the regulation pursue making sure that every hedge fund manager has an independent custodian, an independent fund administrator, and an independent auditor. And if all hedge funds had those three things, most of the things that we read about in the paper about hedge funds and mishaps and blow-ups and things like that would be eliminated if there was that independence added to the operational structure of a hedge fund, which is different than what the manager does from an investment standpoint.